Hey, what's going on, everybody? This is Sam Kwok here.
And this is Daniel.
And we are the Kwok Brothers. And welcome back to our housing market report. And today we're going to talk about, will the inflation last forever? Is inflation truly transitory?
Right. Exactly.
Or is it permanent?
Is it here for a good time or is it here for a long time? So this is a question that everybody is asking right now. How is inflation going to affect the housing market? Because obviously, as we read up on, inflation last month at the end of the 12 months, May, was 5%.
Yes.
5% up from 4.2% in April. So of course this begs the question, is it here to stay? Is it more so transitionary as Jerome Powell says? I don't know, Sam, why don't you get us started?
Yeah, well, what's not transitory is the fact that you're gonna go ahead and smash the like button and turn it blue and make it all nice and sparkly as we all want it. So let's go and first talk about and set the stage as to what caused the inflation in the first place. And now, ultimately, this is the thesis that I want to throw out there, and Daniel can disagree, and we're gonna have a conversation, and we'll state the facts. And I believe that the true inflation that we're seeing right now is primarily caused by the fact that there's more demand due to reopening, there's more buyers, more cash in the consumer's hands, and people just want to buy stuff. But due to the pandemic, there hasn't been a sustained supply chain, not enough inventory to keep up, not only in the housing, but also in just the general goods overall. So I think as things are reopening, more people are getting vaccinated, more demand's picking up, but there's just not enough supply for the market to meet the demand.
So yeah, it of course begs the question, right? What came first, the chicken or the egg?
Right.
You know, did inflation happen because, well, we have too much cash and too much credit available in our economy and it's increased the purchasing power, and, you know, or is it because of supply chains, right? Is it because of, you know, obviously a lot of individuals are short-staffed right now with their small businesses. Yeah. We're having issues with transportation in terms of being able to get certain goods and services across borders. Yeah. You know, what did come first?
Yeah, so one of the factors to consider is that Wall Street Journal is talking about how businesses are hiring crazy right now. Not enough people are returning back to the workforce. There's still approximately 9 million unemployment right now as of May. So right now, a lot of businesses are wanting to get more workers. And one of the ways that they're doing that is increasing wages, doing sign-on bonus. And what one theory is that because now there's additional input costs to producing a good, meaning it costs more, you need to pay more the employees to produce the same goods. Well, that cost is ultimately passed down to the consumers, and therefore the cost of goods naturally rise up due to higher cost of production.
Yeah, and you know what? I don't think we've ever seen in the history of our economy, we've never seen monetary policy and fiscal policy fire off at such extremes, both at the same time.
Absolutely.
You know, but we've seen this a lot, you know, obviously in 2008 to respond to the Great Recession, the Obama administration, they fired off a lot on monetary policy. You know, they did a lot of quantitative easing, which is where it started. Yeah. But right now we're seeing fiscal policy in the form of stimulus programs, in the form of, you know, unemployment benefits and all these things that are kind of incentivizing individuals to stay home and, you know, not go out and work. And I know there's a lot of individuals complaining like, well, it's because they're not paying a living wage, right? Well, I call BS on that. Literally, if you go on Indeed right now and you see the amount of jobs that are paying for over $15 an hour, you know, $20 an hour, there's plenty out there.
I mean, wages are going up.
It's 100%. Insane. We have friends and ourselves, you know, we're hiring jobs that are paying well above $15 an hour and nobody's coming in. Yeah. Nobody's applying.
Yeah. And of course, in another Wall Street Journal article, when Jerome Powell was posed this question, like what is actually happening with inflation? The Fed chairman, Jerome Powell, basically said that inflation isn't happening in all categories. Jerome basically said, hey, we're seeing inflation on specific sectors and categories that have a direct impact from the pandemic. So let's see if Jerome's right, because you know he can say all kinds of things. Right now, looking at the, and this is from Statista, and we're seeing a 12-month percentage of change on the United States Consumer Price Index. So this is looking at May's number. So right now, the biggest change that we're seeing is gasoline at an increase of 56.2%. Now, Jerome might be right about this in the sense that, well, during the pandemic, people were traveling less, people were working from home. There's less car travel in general. And now that things are opening back up in May, April, we could see an increase of gasoline prices because all of a sudden there's more drivers, more people leaving their house to actually go to work now, more people traveling. So gasoline can definitely be, I mean, I might be right. There's a pretty good correspondence there. So if you notice in the chart that I'm gonna show you right now, the gasoline prices last year, we did have a deflation about 16, 17%. So the gas prices went down 16, 17%. And the fact that we're seeing increase of 56%, it looks like we're actually catching up. So inflation in this case might be just natural in terms of market coming back, employment coming back, and people traveling more. Another area is obviously transportation or airline price, which if we go back to the chart, transportation's at 20% increase in May 2021. But if you look at the 2020 numbers as far as airline price goes, well, we're seeing a deflation of nearly 18% of airline prices. So really what we're seeing is just, again, rebounding back to the normal levels. So what it seems like a massive increase in costs, it's really not when you look at last year's inflationary rates and the prices that have fallen last year due to the pandemic, because obviously less people traveling, less people driving out, and so on. So Jerome actually might be right based on our independent research that shows that inflation only happened in critical areas such as transportation, gasoline prices, airline. But of course, what is an anomaly is the construction prices, just like what we talked about in the last video, wood prices going up, paint prices going up, although we were seeing those types of prices coming back down again and settling back down to a lower number than May 2021.
You know, I would actually respectfully disagree with that, Sam, because if you think about the real reason why inflation is going on right now is because obviously we have monetary policy and fiscal policy both firing off at the same time. And I would actually allude to a major part of that is probably because, you know, obviously if you look at the Fed balance sheet, I mean, it's gone up $6 trillion. I mean, it's gone up astronomically. And of course, Jerome Powell is going to be the guy that says, oh, guys, don't worry about inflation. It's just transitionary. Well, sure, right? That may be the case. But if you think about last year, part of the reason was because of the pandemic. In my opinion, the Fed and monetary policy and fiscal policy, in my opinion, may have overreacted in terms of what's happened with the pandemic last year. I mean, they assumed the worst, which I guess is good for that scenario. But I mean, they fired off way too much things to the point where we've kicked the can so far down the road that we don't know how we're gonna come back from this.
Well, and that's why I believe that the Fed had come out and said, hey, we're gonna raise the interest rates in 2022, 2023, separate from inflation. Although I think interest rates will definitely be a tool to cool off inflation a little bit, to get the money supply back in Fed's hand. But I think the way that Fed's going to respond to the crap ton of spending and monetary and fiscal policy that has affected last year is the interest rates. And also fiscal wise, I think we're going to see, of course, tax rates increasing. But that's interesting because, we talked about it as far as housing market goes, raising the interest rates or raising the tax rates as far as penalizing production of housing may have even more severe consequences towards housing prices going up, and it's just not going to meet the demands for the need for more housing.
Here's the big question that we got to ask though: is that going to be good for the economy? Because consider this, right? Inflation that we've experienced really this year and last year has caused the cost of goods and services to go up. Is it wise for them to increase rates, stop open market operations, and decrease the money supply at a time where costs and goods services are already up? Obviously, we have things that are outside external control, like the cost of construction, the cost of crude oil. I mean, you name it. Do we want to do that while, cost of housing, rent is going up, money supply, at the same time they want to turn that down? Really, the average household income has not increased that much substantially the last 18 months, while the cost of goods and services were up by inflation. So my question is, does the Fed really want to do that? In my opinion, that you're setting yourself up for something that's really drastic.
I think they're being forced their hands at this point, because what else are they going to do? I mean, I can't imagine them keeping the rates at 0% for this long and having their balance sheet reflect the way it is. We're close to $7 trillion. I mean, their only option at this point is raise the interest rates. And whatever the consequences comes from that is going to happen. But what's interesting to note, we're in the topic of inflation. If you look at the expected inflation over the next 10 years, it's actually been declining the last 30 years. So if you look at the chart, it's a downward trend. Yes, we're experiencing a little uptick now, but we've been pretty deflationary for the last close to 30, 40 years, if you look at the chart overall. So inflation, again, by the way, inflation is inherently not a bad thing. We actually need some inflation to kind of encourage the consumers to not stockpile cash in the bank account, to encourage a little bit of spending. But of course, too much inflation can, obviously be unhealthy for the economy overall. So when the media talks about, oh, inflation is here, oh my gosh, everyone panic, I don't really see the need for the panic. And I'm kind of on the side of what Jerome and Janet Yellen is talking about in terms of I don't think inflation really has to worry. And you look at the bond market as well. The bond market hasn't been panicking either about the talks of inflation. So I don't think inflation is here to stay. My guess is give it another year or less, and I think we're going to be back to normal level. Some might even suggest that we may see deflation because now companies are overproducing to kind of catch up. So we may see an oversupply of certain goods. But again, we'll have to see and take a look.
Well, I don't know. I actually would respectfully disagree. I think the issue is
disagree away, sir.
Yeah, I don't think the issue is going to be how long inflation is going to be, but more so what is the aftermath of of major inflation? Because if you think about it, the Fed's been targeting 2%. They've increased that to 2.5% recently, but they've been targeting 2% inflation for the longest time. I mean, we had a 3 to 5 year stint where we were at 0.7, 1.6, 1.4 all of last year, and really the year before we saw kind of the range between 0.75 to 1.8-ish, right? But it's really the aftermath of what's going to happen because, well, if you think about overproduction in a lot of consumer goods and services, well, I would actually say in that case, they might be a good thing because if you think about what the purchasing power of the overall economy is going to be, it's going to be a lot less. So if you think about what a healthy economy is it's when your purchasing power of your consumers and also the cost of goods and services are balanced out, right? It's mono e mono, right? Sure. The real problem is what you have when you have one fluctuate over the other, right? We saw a lot of what happened, especially in the housing market. You cannot think of a better example of purchasing power being way too high and then yet the supply being at kind of regular levels. Because again, people talked about low inventory. Well, you got to think about inventory historically has been the same. It actually has been. The amount of houses on the market, relatively was very similar. It's just that the days on the market were such lower. I mean, we were seeing 50% decreases, 100% decreases in the amount of time a house stays on the market. So yes, maybe at a certain time we had less houses on the market, but that's mainly because they had such a high transactional volume. So in that case, we saw a really, really unhealthy housing market. And sure, it was hot, but the way the media describes hot is, the prices necessarily. But well, hot for who?
Yeah.
You know what I mean? Hot, not hot for the buyers. So, that's a phenomenal example of fluctuation between purchasing power of your average consumer and the cost of goods and services. I'm really curious to see the aftermath of what this big jump in inflation is going to be in the year of 2021. My assumption that it's not going to be great. I think the aftermath of such high inflation increases is not going to be as great. I think there actually is a lot to worry about. And I think the biggest questions that we have to see is how is the Fed going to respond moving forward? Are they going to use the tools that they described? Because those tools, quite frankly, have extreme consequences that not a lot of people understand. So of course, this begs us the question, well, what does that mean for our viewers? What should they do right now? What should we do right now? In my opinion, right, depending on who you believe is right, and let me know in the comment section below if you agree with me, if you agree with Sam, right? Are you team Edward or are you team, what was that?
Jacob,
yeah, whatever.
I don't know why I know that, that's weird.
Yeah, Sam, why do you know that, Sam? All right, hey, man, no judgment.
Little Twilight over
there, sure. But who do you agree with? Let us know in the comments. But what does this mean? What should we do? In my opinion, I would take advantage of what's happening in the economy right now. If you're an individual who, maybe you have less than $250,000 to invest or whatnot, and you want to keep your investments going, and you're worried, right? If you have money in the stock market, you have money in crypto or bonds, and you're extremely worried on, what is going to happen to your investments, I would do two things. First and foremost, I would move some of that money into inflation-hedged investments, i.e. real estate, i.e. insurance, i.e. A couple other things that you could list off.
And just to let you know, this is not an advice for investment. Of
course.
Just, this is what we would do. If we had...
Well, this is what we're doing, right?
That's right.
And we're just letting you guys know what we're doing. And second option is I would actually utilize a lot of banking vehicles, such as lines of credit, HELOCs, right? I mean, it's reported that the average American has the highest amount of equity in the home as of right now. And obviously it's because the valuations have increased so drastically in the last 12 to 18 months. I would take advantage of that. Right? Get your lines of credit, be able to do that while you can, stockpile cash and credit to be able to take advantage of investments that come.
So with all that being said, guys, if you guys enjoyed this content, if you loved our insight, go and leave your comments down below, as well as subscribe, because we're going to provide all kinds of insight, market news, housing market news. We want to give you the clarity and certainty to take action to go start making money in real estate, as well as some of the other investments. So that being said, guys, thank you for watching, and we'll see you in the next video.